we all know, anybody who paid attention, watched that big move up in the bank stocks over the last quarter in particular of the year, outperforming the S&P. As we are in this year, how important are these earnings to justify the valuations that banks ascended to only over the last few months?
Well, thanks for having me on. Look, I think the quarter itself is important, but it's really about the outlook and whether the outlook can really justify what have been pretty material moves for the largest banks. And our downgrades last week of JP Morgan and Bank of America to neutral ratings weren't necessarily reflective of a more negative view, a fundamental view of each of the stocks. It's really that we just feel like they are pricing in a heck of a lot and that the bar has been raised quite a bit. So for us, you really would need to see material profitability expansion for both banks to be able to justify the kind of upside you would need to justify a buy rating. So for the quarter itself, look, I actually think the quarter will be pretty good. And I think it'll be pretty good for JP Morgan. We're actually above consensus for the fourth quarter. I think the question for JP Morgan and for the rest of the group is, what are they going to say about the outlook from here? And is the outlook going to be sufficient to really justify the kind of moves that you would need to, or the kind of profitability expansion you would need to justify the material upside from here?
Right, a further move from here. Yeah, to your point, exactly. I mean, JPM, you point out, trades at what, almost 12 times 21 earnings, right? It's trading above two times tangible book value at this point. Obviously very different from the likes of a Goldman Sachs. So you don't see much upside in the stock, even if they do report a decent quarter.
Yeah, no, that's absolutely right. In fact, I think that it'll be a pretty good quarter. When we downgraded them last week, we estimated that to see material upside from here, their ROTCE, which is in the 18 to 19% range, would need to get well above 20%. So you would need to see material profitability expansion from here from an already elevated profitability level, from an already elevated ROTCE level. So the quarter could be good, but is it going to give us enough visibility to suggest that they can continue to improve profitability in a low-rate environment, from what's already a pretty high level of profitability? And I think that's a hard bar to jump over for them.
Yeah. All right. Well, we talked JPM, Bank of America to a certain extent. Anything in terms of Wells Fargo, which has had a bit of a different track over these last couple of years, as just try to rebound from significant crisis?
Yeah. Look, I think for Wells Fargo, the quarter probably matters less than even for JP Morgan, for the other banks. Really, to get excited about Wells Fargo, you need to have a line of sight that they can, get past the hurdles, the regulatory hurdles that they face, and start to grow and start to improve their profitability, which has really suffered over the last couple of years. And one of the biggest things for Wells Fargo is, can they right-size their cost base? Can they improve their efficiency levels? Their current efficiency ratio is in the mid-60% range. Just the point of comparison, most banks that we cover are in the high 50% range, and some are even better than that. So the bull case is, look, they're not going to be at that level of efficiency forever, and once they right-size that, their profitability levels can expand materially. The problem, though, is the timing and when you actually get line of sight to get there, and I'm not sure you're going to get that this quarter. You have obviously a new CEO in Charlie Sharp. It's hard for me to believe that we're going to get a financial outlook or guidance that suggests that they're at the point where they're going to start to right-size the cost structure and be able to grow a little bit more again.